Welcome, friends, to this webinar about European Central Bank rate decision due later this week, and the concept of a golden crossover on euro-dollar pair. So, what we are going to do is, we'll just have a brief look at what the market expects from the ECB, and uh, you know, in our opinion, what the ECB can really do, or the kind of the situation the ECB is stuck in. It's in a lot of ways similar to the kind of exhaustion the Bank of Japan is facing. And then we'll discuss the technical outlook on euro dollar pair, and we also have something very special for the viewers out there. It's a unique trading strategy designed for the events like ECB rate decision, and it was discussed on TIP TV. It's a financial channel located in Belgravia, London, and they had a fund manager who talked about this unique trading strategy. So I will be discussing that as well. So let's proceed. Now, ECB preview. The general expectation in the markets is that the central bank would extend the maturity of its QE program from March 2017 to September 2017. If you remember, when the ECB first launched its QE program, the maturity was set. The maturity date was September 2016. It was later pushed on out to March 2017, and now it's the expectations are wild that the maturity would be extended to September 2017. So, what impact can the extension of maturity have? By itself, it's sort of a non-event for the markets. Euro dollar pair or stock markets aren't really going to enjoy this announcement. But what the extension of maturity means is that eventually European Central Bank would have to discard the self-imposed limits. For example, it does not buy bonds which carry yield lower than its deposit rate, which stands at minus 40%. So if they decide to extend the duration of its QE program, either they would have to expand their portfolio, their purchase list, or their shopping list, or they would have to squash their the deposit rate condition, and that would eventually that could eventually weigh over the common currency. This is because the bank is already facing the shortage of bonds, because most of the bonds, German bonds, if you look at the short end of the German bond yield curve, what I mean by short end is the bonds which mature in 2 years, 3 year, or 1 year. Their bond yields are way below the deposit rate, and that makes life difficult for the ECB for the QE program. And so if they decide to extend, either they'll have to expand their shopping list, include new items, or they would have to eventually simply ditch their conditionality of the deposit rate. The second point, as we have noted here, is exhaustion too much too soon. If we go back 2 years and 4 months or so, that is May 2014, till then, from 2012, from August to September 2012 to early 2014, first half of 2014, ECB was known to be a sort of a disciplined central bank. Their balance sheet was shrinking, and Draghi would say that they would not go on a easing binge, and so it largely carried an image of a disciplined bank. And in terms of easing, monetary easing, it was lagging behind its peers. It was way behind what Bank of Japan was doing, or what Federal Reserve had done. 3 rounds of QE, rate cuts, near zero rates, 3 rounds of QE, Operation Twist, and Bank of Japan did 2 rounds of QE, massive easing. And so when you compared ECB back then to its peers, it largely appeared to be lagging behind. But in just a span of 2 years, BOJ, European Central Bank, matched its peers now. It has negative rates. A deposit rate stands at minus 40%. It has a QE program is doing TLTRO. So when the central bank does so much in a very short span of time, it risks losing the efficiency. There is no surprise factor involved now for the markets, and thus there's no not even if the bank pushes the interest rate lower, let's say to -50% or -60%, it's not really going to have any big impact on euro. In fact, there's a risk that euro may rally simply because these negative rate strategies are not working as they are meant to, in the textbooks. And so it's facing exhaustion, and that is why, similar to the Bank of Japan, it hopes that Federal Reserve does the heavy lifting, so that if Fed tightens its policy, it continues with its policy tightening, hikes rates by another 25 basis points, indicates more rate hikes to come, then euro would take a hit. But I don't really buy this argument, because it won't just be euro that would take hit against the dollar. You would also have yen weakening against dollar, pound weakening against dollar. Almost all currencies would weaken against euro, against the US dollar. So there won't be any a notable benefit for any individual nation because of the weak currency, because all currencies would weaken. And so, you know even though BOJ, in similar ways, like BOJ expects the Fed to do the heavy lifting, ECB too is praying for Fed to do the heavy lifting, but at the end of the day, it's not going to have any it's not going to provide any specific benefit for Eurozone or Japan. uh, you know and so that is the ECB preview. And you will also have Draghi press conference, and his comments on the political situation in the Eurozone would be watched out by the markets. We have a sort of a Spain is without government now for almost 8 months, and today's German regional elections were turned out to be bad for Angela Merkel, and there is a referendum coming up in Italy as well. So his comments on the political situation would be watched out. As far as as far as the trading the ECB rate decision is concerned, as I introduced, we have a unique video from the Tip TV, and you can follow it up on the YouTube. And the title goes like this: Trading the Central Bank Rate Decision, FX Master Course. Yeah, the fund manager, Corvin Cordilla, discusses his strategy, which suggests that as a trader, you or me, what we need to do is we need to jot down the ECB day high and low, because that would sort of act as a strong resistance and support levels in the short run. So it's similar to a channel, so that once the pair breaks above the channel on day and closing basis, preferably you enter long, and if the pair breaks below the channel support on day and closing basis, you short. So let's say after the ECB rate decision, the ECB day high is 1.13 and ECB day low is 1.10. Let's assume we have a 300-point move, for example, just to make it simple. So 1.13 becomes a major resistance, and that is the area above which you would go long, and 1.10 becomes a major support, below which you would go short. So this is the strategy that he discussed. The detailed video, as I said, is available on the YouTube. The title goes Trading the Central Bank Rate Decisions, FX Master Course. Now we go to our own thing about the European Central Bank Rate Decision. So here is what I have on my screen, the FXCM software, and I've drawn a falling trend line, and we can also jot down. So what we have here is the falling. What we have here is a falling channel of sorts right now, and the pair exited the falling channel. It breached it on the higher side on August 15th, but the subsequent move ran out of steam at a high of 1.136, post which we fell down to 1.1123 on August the 31st, and now we are back inside the falling channel. And if you look at Friday's candle, it sort of tells me that bears were reinforced on Friday. and we could be in for more, a pronounced selling ahead of the ECB or even after the ECB. Just going by the chart, I'm not including any uh, fundamental view over here. And as of now, on the daily chart, it appears that if the pair breaks below the ASEAN session low of 1.115, it could head down to 1.11, 1.1080. And a major support on the chart, as we can see, comes around low of 1.1046, which is the August 5 low. And further, this major psychological support of 1.10 is seen. A violation there would open up the downside to 1.0911, which is the Brexit day low. So on the charts right now, it appears as if the Friday scandal tells me that the bears have been reinforced. If you look at the weekly chart, the picture is somewhat, again bearish after the big red candle we have had 2 weeks back, and that goes down well with the bearish view we just discussed as per the daily chart. When you go to monthly chart, we have three candles, the June candle and the July candle, August candle, with long upper body. And when you have a very long upper body, it suggests exhaustion on the part of bulls. And also note that these candles with long upper bodies or upper shadows have are seen after the big red candle of May. So overall, it appears that the pair is heading lower. If we can also note down that 1.1296 is a key resistance. It's a 23.6% Fibonacci retracement level of the move from 1.3994 to 1.04624. That is May 2014 high to March 2015 low. So overall, I guess we are heading lower on charts. The other important point that I wanted to talk about is the uh, much hyped, should I say much hyped, or the golden crossover of sorts on the monthly chart. This black line is the 200-month moving average, and the blue line is the 50-month moving average. And if we get a bearish move this month, let's say to 1.10 or so, we could have a confirmation of the bearish crossover. And usually this is a Lagarde indicator. Many a times, if you search on Google, you'll find many websites or technical experts calling it as a Lagarde indicator, and I agree it is a Lagarde indicator. But given the background of the we have a Fed telegraphing its next rate hike, and the expectation that eventually pound would gain an upper hand over euro. So the drop in euro GBP would also add to the pressure on euro dollar. Furthermore, we also see the kind of political developments right now we see in eurozone. That also suggests me that uh, in this larger picture, this bearish crossover would indicate that there are more losses to come. And so traders need to watch out for this. If we do have a move down to 1.10, I guess this bearish crossover would be confirmed, and then we could head lower to around 1.10750 and 1.105 by maybe Jan or Feb 2017. So as I said, this is not this is a Lagarde indicator. The bearish crossover between 50-month or 200-month moving average. But you got to look at this by taking into consideration the bigger picture, where right now appears uh, pro dollar, or should I say not in favor of the common currency. So that's it for today. I hope you guys enjoyed this, and as I said, just go back to Tip TV's uh, video. The title goes "Trading the Central Bank Rate Decision FX Master Course." It's a good trading strategy, and you can study it and you can check the historical data. It has worked most of the times. If we look, if we just go back to what happened in March, this is the March candle. If you remember, the March 10th ECB rate decision, and this was the high, ECB day high, 1.1218, and the low was 1.00822. So the strategy that they discussed on Tip TV was that you buy above the ECB day high. So the buy signal came. Buy signal was confirmed on March 16th, and post which we had a sort of a fake move lower, and then it just kept on going higher, and you sell below the ECB day low, that is 1.0822. So in case we start going lower from here, let's say if we breach 1.10, you know which is the major level now to watch out for, and that one is 1.0822. So it works. No trading strategy works all the time. No one can provide you 100% results, but it's always good to keep in mind a number of different strategies that are available out there. That's it for today, and we'll see you next time. Thank you.